are you going to flop it on to YouTube, or are you just going to give me a link to do that?
I'll send you the cloud link to it. You can pull it.
Okay.
However you want to do it, man. If this is useful content for other, other students, and
yeah. Well, what I thought I might do is put it on to your Collaborate in your portfolio, so you could kind of have a record of anything we did in case you wanted to watch it again.
That would be perfect, man.
And then other people could also. So
yeah. Okay.
All right.
So
so if you want to start the recording, and then I'll just do a setup of okay, you got the recording?
Rolling. Yes, sir.
All right. Well, I'm Dale Perryman and my buddy Reese Ormont, and we're doing some trades today, and I'm going to kind of coach him through some things. So Reese, tell me something you're either bullish or bearish on.
So, being a technology guy, I am super bullish on a couple of things. There's some companies that I've heard of that are, basically bandwidth enabling services for back-end cloud services. So these are like companies that are helping you get information across the web faster, right? They're back-end players that don't have any consumer-facing brand to them, but there's one in particular that I've heard a lot about lately.
Gotcha. Now, do you want me to let you continue or kind of interrupt as I have thoughts?
Yeah, no, so it's basically, it's going to be these content accelerators, and then Microsoft, the Microsoft ecosystem, we're very bullish on Office 365, the whole Microsoft piece. But
all right. Well, Microsoft, it will be a very liquid underlying in terms of options. If you're trading anything small, you can be pretty sure that the liquidity is not good.
So there's not a lot of options.
And what I mean by liquidity, a metric or a measure of liquidity is the spread between the bid and the ask.
Okay.
If you have a tight spread, then it's good. If you have in what is tight, for Microsoft right now, if I look at Microsoft, for example,
I'm pulling up some chains for you here.
Yeah. For example, I'm looking at some Microsoft, and it's $200 underlying, but the spread is like 80 cents. And if you're trading one contract, that's $80. But you get into some of these, some of the best spreads, like on Apple, if I look at August, like a 4-cent spread.
So yeah, can you do that? Kind of walk me through that, Dale? I'd love to hear your interpretation of all this.
Okay, let me give you an analogy. Let's assume you're using a money changer in Mexico at the airport.
Yeah.
And they see you coming because you're an American, and they know you're on vacation, and all of a sudden the spread between what they'll buy pesos and what they'll sell them for goes up.
Right. Okay.
And so some of these smaller companies with a spread, and it's the hidden cost of trading. So for example, if there's a 4-cent spread in Apple, and you're trading 100 shares, that's like a $4 every time you're making a trade. On the other hand, if you're trading something that's got a 20-cent spread and you're trading 100 shares, that's $20 every time you're making a one contract transaction. And if you're trading a 10 contract transaction, that's $200. So it's the hidden cost of trading.
Okay.
Most people just look at your transaction fees, but the hidden cost of trading options is the bid-ask spread.
Okay. So for option trading, it's best to have the smallest spread between those?
Yes.
Okay.
And so for that reason, I keep a list of probably the 20 most or the 50 most liquid underlyings.
And that's the tightness of that spread is because of the liquidity and the viability of the company, and just because of its everybody knows Microsoft stock is worth X. And so is that why?
Yeah, there's lots of people that are out there trying to buy and sell.
Okay.
Imagine, here's another analogy. You're on eBay and you've got lots of people bidding. There's going to be a competition there, and there's a tight bid and ask.
So can I ask you something, Dale? Can we look?
Yep.
You see my screen here?
Yes, I do.
So I've got this Microsoft chain right here.
Okay.
Let me just pull maybe one up that expires later on.
Okay.
Okay. So
let me tell you I'm going to give you two examples of bullish trades on Microsoft.
Okay.
One of them would be selling naked puts out of the money. So for example, if you like Microsoft at 197, wouldn't you like it better if it was trading at 195?
Right.
And so if you look at the 195s in August, they're trading at $10.15.
So where am I missing the 10.15?
All right, you're in July.
Oh, you're saying in August? Okay.
I was just looking at August.
Okay.
And if you look at the 195 and it's trading for $10, go over to the puts. You're in the calls. Go into the puts, and $10 going to 195, and you're selling them. You're not buying them. So you go over to the 1010. So see if you hover over it and it says buy, and now if you hover over it, it'll say sell.
Yes.
Okay. So what that means here is that you'd be collecting $10.20 for this contract. So if you did one contract, you'd get 100 times 10. $1,000 would drop into your account. Now, you'd also have the obligation to buy Microsoft if it goes down to 195. So if you were doing this in a real account, you'd need to have either the capability of doing that, or you'd have to close out your option if it goes down below 195. But here's, in essence, follow me here on the math. If you collected $10 on a 195 put and it goes down to 195, your cost basis is now 185.
Okay. Okay.
So if you like Microsoft at 197, wouldn't you like it even more if you were able to get it for 185?
Right.
So that's the idea of selling naked puts.
Okay.
And that's the first strategy, and probably the most simple. And the reason I also like it is you're getting something that you like anyway, potentially at a bargain. Now, let's say it doesn't go down to 195 in a month. Then in September, sell it again if you like it at 195. Okay. Collect some more premium.
Okay. And so by selling these puts, I'm saying, what am I, if you were to articulate this in a sentence, like I'm confident that their stock will be worth more than this during this time period. And so because of that, I'm buying, and I have an obligation to buy it if it goes lower, right?
Yeah. If it goes below 195, you have to buy 100 shares if you did one contract.
Okay.
So basically what you're betting on is that Microsoft will be trading above 185 by August 21st.
Okay.
185 is your break-even point.
Sure.
Anything above that, you've made money.
And if it, if it's at 186 a day before, and I, what would I do there? Kill the put, or what is the?
Well, you've got a choice. You could either own 100 shares at a cost basis of 185 and then turn around and sell calls against it, or you could close that option for basically $1 profit minus whatever time is left in that one day.
Okay. So this is just selling a naked put.
Selling a naked put, and it's probably the most simple strategy for people who are bullish on an underlying to do. And if you wanted to go further out, you could. You see, if you sell the 180 put, you're getting $5.
Okay.
It's just
And so
kind of
it's because this is getting less and less likely, which is why you gain less and less value.
exactly. And
Okay.
over there where it shows under delta, you could
Uh-huh.
see the probability that it's going to hit that by August.
Okay. So so I'm betting on this one that, I'm betting with 56% favorability that it won't.
Yeah. And so just like an Omaha hand, you got a 56% chance of winning the pot
Right?
or winning something, being profitable. If there's multiple
Sure.
people in the hand, you got a 56% chance that you're going to make money.
Okay. Fuck it, Dale. Let's buy some then.
Or you're selling some.
Or sell. Yeah, that's what I mean. I'm.
Yeah. Okay.
Yeah. So,
All right.
so let me ask you something. I'm bullish in the sense that they are going to continue to expand their market share. Microsoft Teams has had enormous growth through this. So
Okay.
they had 20 million active users in October, 44 in March, 75 in April. I'm thinking that with a second round of COVID, their value will continue up. That second round, I'm thinking, will be late September, early October. So,
Okay.
given those parameters, should I do some options here that are little, August ones, and then maybe look out further?
No, let's do August. And then what you can do at August is you can roll some out again. So
Okay.
you could sell some in July, you can sell some in August. If you want to look and see what the 195 puts are selling for in August, in July, you can do that.
I
So
gotcha.
I guess
Okay.
kind of what I'd like to do for educational purposes is I'll show you two different bullish trades on Microsoft.
Okay.
So, and you can kind of watch them to kind of get an idea.
Absolutely.
So if you want to, so for example, if you wanted to just put on one contract in August and submit that, and then, we'll sell one in July at 195.
Okay.
And that way you'll kind of see three different trades.
And so
And
now for me to
all
look at this data here, Dell, I want to make sure I understand this. So that's the current price, that percentage change. Do you know what
that's the percent.
did it? You there?
Yeah, I am. I'm looking at. I believe that's the percent of change of that option today.
Okay.
So yeah, Microsoft went down 1.63%, but the puts changed in price 16%.
Okay. Okay.
So
And so this is saying the negative one, obviously I've got to put on this.
yeah,
What is the
and
negative one indicative of?
the negative one in the language. So it's kind of like learning a little bit of the foreign language. So I'm going to teach you kind of survival skills of kind of how to get to the airport and how to order food. So the -1, essentially the language is you have a short put.
Okay.
If you're buying a put, you've got a long put. So you're short one contract, a put, at the strike of 195, expiring August 21st, 56 days from now.
Okay.
So why don't we go and sell at 190, 190 in or 195 in July?
Can I ask you something on that, Dale? So when I sell a naked put there, do I get funded something right now?
Yeah, you. What did it trade for? Like $10?
Yeah.
Okay, so $1,000 essentially plops down into your account,
Okay.
and in exchange for that, you got a contract that you
And
got.
that's this $1,000 right here, right?
Yeah, you basically that plops down into your account.
Okay.
But you don't necessarily get to keep it. It kind of is held in escrow.
Sure.
Um,
That's the optimal value you would get
Yeah.
Right.
So
And
for 56 days, this is how it basically works. So there's $1,000 and you divide 1,000 by 56.
yeah.
So roughly $17.85 is going to plop down. You're going to get to keep it. That's your theta decay per day. Now, I don't want to baffle you with too much bullshit
This is
jargon.
okay. No, this is okay, Del. I will absorb
But
this.
theta decay is kind of like, imagine if you rented out a condo for 56 days and they paid you $1,000. So every day they stay in the condo, you get to keep that $17.85. But they could buy out of that contract at any time.
Okay.
So you've made a deal with them. Yeah, stay in my condo. The thing I'm thinking about staying 56 days. Okay, it'll be $17.85 a day. But anytime you decide to leave, I'll buy you out for the remainder of your contract. But they're paying you $1,000 right now.
Okay. Okay.
And you're kind of holding it in escrow. And now, here's the tricky part. This $17.85, it's kind of like Dallas traffic. Some days you'll make $40 and some days you'll lose $5 because of traffic. And the analogy here, traffic is to Dallas traffic what volatility, which is a perception of risk, changes the speed to which you'll get the theta. Now I may be giving you too much. So I just don't want you to think this $17.85 is linear and necessarily predictable, but an average over 56 days is $17.85.
Amortized over that, but because of the
perception of risk in the market changes, someday you might get 25 and other days you might get 4 in theta decay, but over the time period it's going to average $17.85 per day in theta decay.
I gotcha. And so like say Microsoft has a massive security breach tomorrow.
Yep.
And their stock is plummeting. What happens to the theta decay? Is it accelerate that? Is it?
What happens is all of a sudden those options become more expensive because there's a perception in the marketplace that Microsoft all of a sudden is a lot more risky. Okay. So right now it's Microsoft implied volatility is 36.75. A security breach happens and all of a sudden the implied volatility is 75. So it's doubled. And so all of a sudden these options prices double. So this $1,000 that you collected, now it's going to cost you $2,000 to close that.
I got you. So where did you find the options, the volatility?
I'm looking, and if you want me to share my screen, I'll show it to you on TOS.
Let's see the Jedi screen here, Dale.
Okay.
Here, let me kill my share, and then you can.
All right. Now, since
I may have to grant you permission to screen share. Hold on.
Yeah, you can do that. Yeah. Let's.
Cool.
I'm going to change a privacy setting on mine just so since we're recording it, we'll go out there. You won't be able to see account numbers or anything like that. Cool. So, all right, I'm going to share my screen now. Host disabled participant screen sharing. So if you'll enable it for me.
Yeah, you should be good now.
All right. All right, you'll see an option chain here. And you may not be able to see these same things, but this is the Thinkorswim platform.
I gotcha. Okay.
And do you use the Thinkorswim platform, or have you used it?
Dell, I watched about 4 or 5 worth, a few hours worth of the videos, and I kind of stalled out. I actually stalled out around the walkthrough of the platform.
Okay. Well, Microsoft here, if this is the Thinkorswim platform, and it's kind of like flying a 747. So there's a lot of features here that I don't even use, but there's certain ones that I do. And so here's an option statistics.
Okay.
And if I go down here, there's an implied volatility of 36.8 on Microsoft, and it's currently IV percentile. And this gets maybe more complicated than you need to, but this is comparing implied volatility against itself. And this is kind of its current implied volatility. So these are two numbers I look at, the IV percentile and the implied volatility. So, and what's impacting this for the whole market is VIX, which is a measure of the volatility of the entire market.
Yeah.
So usually because the market's down considerably today, volatility of the whole market is up 2.9, which is kind of 9%. It's trading at 35.12. But if you look at kind of over a longer period of time, you can kind of see that volatility, it ranged down here about between 13 and 15. And this is kind of what happened with COVID. It shot up to like 83, and currently it's trading, in the 30s.
Yeah. Is VXX similar to that? Is that another volatility index?
VXX, I think, is something that it trades. It's an underlying. VIX is not, it's tradable directly.
Okay.
But it may be a leverage type thing that I'm not quite as familiar with.
Okay.
So that's
that
kind
market
of
volatility. There's not an underlying to that. That's just
VIX is essentially the measure of market volatility of the entire market.
Sure. Okay.
Chicago Board of Exchange Market Volatility Index.
Okay.
So let me just that's a short lesson on perception of risk. And that's a thing that's the uncontrollable that affects everything. It's kind of like what affects the ocean and tides and the moon and, but a big factor that we can't predict. So just go ahead and share your screen again.
Okay. And you would say that the that implied volatility, that's so a profitable company with a good balance sheet with low debt, they're going to have lower volatility, right?
Yes.
Okay.
But typically technology has higher volatility than, say, Johnson and Johnson.
Sure, because that's a very standardized product, a lot of low,
very risk. Stable. Yeah, not as quite as much change. Now, they might argue, but it's Procter and Gamble. The volatility. Let me just check what the PG. Its implied volatility is 29, so it's not too shabby.
What are the highest volatility industries that you know of? I mean, is it SaaS, software, and that kind of stuff?
Let's see. It does vary somewhat, but like right now, say Tesla is pretty big. Let me see what its volatility. It's 76. So Tesla's a big one.
Yeah. That's another one I'm very bullish on. I'd love to pull some lesson on that.
Well, I tend to be bearish on it, but you're in good company. I mean, my partner in this, Mike, is bullish on it, and I've been wrong, but
who long term that I would love to, and the whole category kind of amongst that is Richard Branson's Virgin Space.
Okay.
That's a big one for me. Blue Origin, SpaceX. I'm very bullish on all of them, but particularly Branson's.
Okay. Well, I would probably take the other side of that trade too. So that's good that we have a two-sided. That's what makes a two-sided market, right?
Oh yeah. Well, and I'm kind of speaking out of my ass here, Dale. I'm following these as a technology fanboy, but being very the futurism stuff. So
Yep.
Singularity and Kurzweil and all. I'm Skynet. That's kind of
Yeah.
that's my whole line of work. And so
Deep down, I'm still a fundamentalist, and I like to look at some fundamentals. But we won't get into that lesson today. So why don't we put in another small trade, small given if your account size here, and it's a paper trader for those of you who are watching the video. So we're not trading a $250,000 account here, but we could be. So go ahead and put in at Microsoft again there, and let's just sell what's selling one in July, and
tell me this too, on these option chains, the monthly and weekly, is there any?
Monthlies tend to have better liquidity, and that's the reason it wouldn't affect you that much in a paper trading account. But if I was trading, I want to teach you principles that would apply to real money also. So that's why I primarily trade the monthlies, is there's more liquidity.
Okay.
So why don't we go into July and sell a 195 in July. Okay. So July 17th, 21 days monthly, go down to the 195 put, and then click on sell. Okay. And let's just do one contract, click on that. One contract is good, we'll click on submit. Now you see that theta is $14.40?
Yes.
That's what you'll collect on average per day.
Okay, very good.
Click on submit. All right, so I'm not sure if we'll have enough on margin here, but let's do one other bullish trade on Microsoft. And so I've taught you how to sell naked puts, and now let me teach you how to sell, create a poor man's covered call. So first we want to go, in September, and I'm going to give you the one sentence about what we're doing, and then we're going to do it.
Okay.
The one sentence may sound a little complicated, but any more so than you didn't know poker, and somebody would say, you're on the button, and you go, what's a button, right? Yep. So here's the sentence. We're going to buy an in the money option in September, and we're going to sell an out of the money option in July. So if Microsoft is trading at 197, an in the money option would be 190. So why don't we buy the 190 in September? Okay. A call.
Okay, would this be it here?
Yep. Yes, click on that. And then we're going to sell, let's say, the 205. We wanted to put both legs on at once. So that's all right. That's all right. We can go back in. We'll leave that one on, go into trade again.
All right.
But in the future, you can put both of these legs on at the same time.
I gotcha. That would make sense if it's going to be a...
Yeah. Yeah. And so we're now going to go into July.
Okay.
And we'll sell.
Do I need to add that other leg?
Okay, that's September. No, we're going to go into July now.
Okay. All right.
July monthlies.
Cool.
And then we'll sell, say, the 205 call. Go into the call on the left. Puts are on the right. 205 call. And you'll click on that. And we did one contract, right?
Yep.
And so you'll submit that.
Okay.
Now I'll set it up on toss. So we bought the 190, right?
Uh-huh.
And we sold
for 205.
The 205 in July.
Right.
Now enable me. I can hear some kids in the background.
Oh, yes.
They're probably doing something fun by like driving that car around.
Oh, they're being pretty calm today, actually, so that's good.
Yeah. Why don't you let me share my screen?
Sure.
And what I'm going to show you now
So,
is
the combination of those two trades, and what I should have done there, Dale, is when I was buying the first one, then you just hit that plus and add another chain to that. Is that the right verbiage?
yeah, you put both of them on together. Both the verbiage is legs, so each one of these is a leg. So what I'm going to do is I'm going to show you this kind of a risk. This is called a risk graph, and it's on Thinkorswim. It enables you to kind of visualize this trade that we put on. All right. So what this has is it's got a 53% probability of profit. And that's I like these kind of trades because I want something that's bigger than a coin flip. You know, and the analogy is I want to be the casino and not the gambler.
Yeah.
So, you know, we're sitting there in blackjack and I'm the house and I got a 53% edge and I'm wanting you to stay there and I'm going to limit your bet sizing and you want to stay there long enough and, you know, give you enough comps to stay there until, you know, you go home broke and then I want to own, right? So here's basically the risk graph. And, you know, I want to make sure this is today's date and up here it's the date of expiration in July.
So you threw all that data of the transactions into this.
Yeah,
and then it built the graph.
I've clicked on it, and this is the risk graph. So Microsoft is currently trading at 198. So kind of here we are at 198. So what you can see is as Microsoft goes up, down here, there's like a little number here, and it shows you how much I would make at today's date if I closed it and on the date of expiration. So I'm moving my cursor, and that's current price of Microsoft. But let's say it starts going up here. You can see how those two numbers start to change. And your max profitability is if it is at 205 on July 17th.
Right. Okay. And is that when it expires?
That's when that short leg expires.
Okay.
Now the cool thing about this is you can then roll July into August, sell it again, that short call, and then you can roll it from August, September, and sell it again. So you've bought a little crack house here for $1,429, and essentially it is earning you for the next 3 months. You know, let's see what we sold it for again in July. You're essentially collecting $300 a month for the next 3 months on this little crack house that we bought for $1,400. So that's some good crack right there.
That's right.
Yeah. So that's the reason I like these little, and you know, you can, if you're long-term bullish on Apple, you could gone out and bought this in January and you'd have more months to sell premium. Just keep rolling premium. You know, for stuff I'm long-term bullish on, I love to buy the Januaries and sell premium against it every 30 days.
Okay. So that's, I feel like I'm absorbing like 30% of this, Dale, but
that's why we wanted to videotape it.
This is great.
And so, that's called a poor man's covered call.
Okay.
I'm going to stop the screen share and you can share yours.
No. Cool. All right. And it's, you know, so it's something, if you're bullish long-term on it, you're saying you buy the January, like right now, you would buy the January options for Apple, and then every month you would just sell against that.
You would buy an in the money option further
Okay.
out in time, and
Okay.
you sell an out of the money option in the next month coming up out of the money.
Okay.
And so now what I've done is we've put on 3 tech trades in Microsoft. One of them in July, selling the out of the money put. Second one is in August, selling an out of the money put. And the third one was setting up a poor man's covered call.
Okay.
So 2 different strategies, both of them relatively simple.
Yeah.
But theta decay is working in your favor.
And when you say in the money on those strike prices, like why is 190 in the money and 205 isn't?
Well, it's because you're buying something. So Microsoft is trading at 197. So in the money is anything below 197.
Okay. Okay.
Out of the money is anything above 197.
Okay. All right. And so if if the stock price shot up tomorrow to 207, then all those would be in the money, right?
Yeah. Yep.
Okay. All right.
Now, let me see what trade you have on Royal Caribbean.
I didn't know what the hell I was doing here, man.
It's all right. You bought 25 puts. So you're really making, and the reason I'm just explaining to you, when you're buying an option, theta decay works against you.
Mm-hmm.
When you're selling an option, theta decay works in your favor. So anytime you're buying a call or you're buying a put, you're stepping up to the blackjack table. Your probabilities are lower, but if you're successful, you could potentially win big.
Okay. Anytime you're buying a call or a put, you are stepping up to the table. Anytime you're selling a call or a put, you're the house.
Yeah.
Okay.
So, Mo in the contest is gambling it up. He's successful right now, but if you were to do it in a real account, eventually, probabilities are going to come and affect you, right?
Yes. Yeah.
Okay.
Okay.
So that's kind of the premise.
All right. So, like when I bought, can you like look at that Royal Caribbean transaction for me and tell me something, man?
All right. You bought 25 puts at $40, and Royal Caribbean is currently trading at 46. So you have the right to buy Royal Caribbean at 40.
Okay, and it expires in 6 days, right?
Yeah. So in every day that passes, you're basically paying a significant amount of theta decay in order to gamble. So your rake is significant there. If you go over further to the right, scroll to the right, and let me see what your theta is. You're paying $309 a day to gamble that Royal Caribbean is going to crash below 40 in the next 6 days. So if you knew something, this would be exactly the trade to make.
Okay.
But I believe that nobody knows anything.
Yeah, and I've been, the limited knowledge I have of all these things. I mean, I've been hearing that, on the stock shows on CNBC that Royal Caribbean's kind of rebounding right now.
Okay. I can show you how to put on a positive theta decay in Royal Caribbean.
Okay.
Which is not gambling.
Yeah. What should I do with this here then, Dale?
I just close them.
How do you close this out?
Okay. Right click over Royal Caribbean. Just go over here to the symbol, right click on anywhere on that line. I'd point at Royal Caribbean
Oh,
and then go down to close and
okay.
then just close it and then submit.
Okay.
Okay.
Cool.
Now you want me to show you how to put on a bearish trade in Royal Caribbean that
Yeah,
is
yeah.
in fact has positive theta decay.
That sounds like a winner.
All right. Now,
And
one thing you could do, a simple trade, which is exactly the reverse, go down here to July, is the reverse of selling a naked put, sell a naked call at 48 out of the money.
40.
48, a
Oh,
call,
sorry, 48. Okay.
48 call, sell it, don't buy it.
Okay.
And
So what I'm doing here, Dell, is I'm saying, can you phrase this up for
yeah,
me?
if it goes up to 48, you're going to have to short the stock.
Okay.
You're going to be short Royal Caribbean at 48 if it goes up to 48. If it doesn't, you're going to collect $400 and say, thank you very much for the opportunity. I'll see you again next month.
Okay.
But you're hoping that it goes down and this expires worthless. So why don't we just, put on 2 or 3 contracts here, and then I'll show you another bearish trade in Royal Caribbean. And
Okay.
this one is selling doing a poor man's covered put.
Okay.
So why don't we go into September and we'll buy the 40. Let's buy the 50
Okay.
put and leave that trade on, and then go up, and we're going to sell the July 40s.
Okay.
Puts.
Okay.
All right. So, all right. So your theta decay every day is $3.48. So you're still collecting. You're still got the current at your back, and you're swimming with the current here, to follow the analogy.
Okay.
Now, interested? Do you want to see a risk graph on this one?
Sure. Absolutely. Let me
All
show
right.
my screen share.
So let me put it on. Remind me of what we just put on. So we bought the September 50s.
Yep.
We bought the September 50s.
And you said you usually do these on monthly still because there's more liquidity to them?
Yes.
Okay.
All right. So I'm going to go down and I'm going to buy the 50 puts. And then I'm going to sell the July 40 puts. And I'm just going to show it to you on one contract, just to kind of look at the risk graph here. All right, so here's that risk graph. So this one has a 62% probability of profit. So I love that. It's one of those table games where the odds are favoring the house even more. And so Royal Caribbean is trading at 46.50. And so here we are at 46.50, and watch the numbers here on that screen as if Royal Caribbean goes down, you can see how your profitability. So your maximum profitability is if it closes at 40 in July, right?
Yeah. When where are you seeing the time? Oh, the date is right there. Where are you seeing
here? See these numbers here? Can you see my cursor?
Okay. Yeah.
Okay. One of them says June 26th, and the other one says July 18th.
I gotcha.
See how these numbers change as I move it along the x-axis on price? All right. So just let me show you kind of if I was more bearish on it, and I wanted to gamble a little bit more, let me show you. I'll change these to 35. I collect a little less theta, but I can make a lot more here. So you just decide how bearish you are.
Yeah, and when you made that change, I know the probability was 63 before of profitability. Where are you seeing?
Now my probability is 61%.
Okay.
But I still, if I'm wrong, I could lose 870. If I'm right, my maximum win is 785. I'll change this back to 40. My preference is I make a lot of little bets. All right. And totally. I don't like to keep a huge range because, people overestimate how right they're going to be. So I just try to hit a single and every time I get up to bat. But, it looks like your maximum loss here is, 760. Your maximum gain is 440. But your probability of profit is better than a coin flip, which is always my goal.
Yeah.
And that's why I'm advocating to newbies, and it goes against what most people do, because I'll say 90% of all options traders lose 90% of their account in the first 90 days. And the reason is because they step up like they're playing slots.
Mm-hmm.
And, sometimes
that's not a sustainable way to do this.
Yeah, it's not replicable. It's not a good company that's making money every day when they come to work.
Yeah. So let me ask you something.
Go ahead and share your screen again.
Cool. And then I do got a hard stop here in a couple of minutes.
All right. Is there any other trades you want to put on?
I think, dude, if you can
go ahead and put this one on.
Yeah. Show me how to do something bullish on
now you see you've got $70 a day in daily theta decay that's going to drop in your account. So that's a good thing.
Where are you seeing? Okay, there we go. Cool. That's the portfolio theta. Okay.
Yeah. And you've only allocated 5%. So you got plenty of space here to put some more stuff on.
You know what I think I should do, Del, is now that I understand a little bit more of that and have a baseline for this and a recording, I need to invest a little more time in this. And I'd love to set up a couple more of these and be able to explain them to you. And maybe one day next week we can spend a little bit of time together kind of going.
All right. Fair enough.
Dude, awesome. Thank you so much. Hey, I have some other ideas I want to talk to you about this. I think you're onto something great here. So.
Okay. Thanks, man.
Awesome. Thank you so much for your time, Del. I really appreciate it.
All right. See you, man.
Okay. Take care, bud.
Right, bye.
I'll see you. Bye.